Let's look at money, banking, and monetary policy. There are basically two types of economies. The first type is a barter economy where individuals exchange goods for goods. For example, if an economics teacher wanted a hamburger, she would offer the cashier at the fast food restaurant a short lecture on economic theory in exchange for the hamburger. If the cashier perhaps wanted to hear a short lecture on economic theory, then the exchange would take place. The situation where both individuals want what the other has to offer is called the double coincidence of wants. If the cashier did not want to hear an lecture on economics, our poor economic lecturer would need to find what the cashier wanted besides money and trade the economic lecture for that item, and return to the fast food restaurant and then swap the item that the cashier wanted for the hamburger. In a monetary economy, individuals use a tool called money to eliminate the double coincidence of wants. So the economics instructor gives lectures at a community college for money and takes the money and goes to the fast food restaurant and buys a hamburger because the restaurant wants cash, so he can buy the things it wants. Money can be anything that is easily exchanged for goods and services. In parts of Africa, cowrie shells have been used. In the American South in the 16 and 1700s, tobacco was used as money, and in Michigan in the 16 and 1700s, beaver skins were used as money. Silver and gold were used in Europe until about the 20th century. There are three types of money. First, there is commodity money, representative money, and fiat money. So let's take a minute and look at each of these different types. Commodity money is any item that is used as money which also has intrinsic value. That is something that had value even though it wasn't used as money. Representative money is money that has no intrinsic value, that is made from a material without value, but can be exchanged for something that does have value. The last type is fiat money. This is any item that's used as money which has no intrinsic value but is given value by order of the government. Legal tender is money that must be accepted by the seller by order of the government. A gold coin is an example of commodity money. This coin has a value of $1, but the gold content makes it worth about $1,000. The above example is of representative money. While this looks like a dollar bill, but it is actually a silver certificate. Notice the words silver certificate printed on the bill. Before 1973, this bill was redeemable in silver. You could take this to the Federal Reserve Bank and get a piece of silver worth $1 from the Federal Reserve. This is a typical $5 Federal Reserve note or $5 bill. The value of the materials that make up the bill are about 5 cents, and it would not be redeemable for any precious metal like gold or silver. Thus, the value comes from the fact that the Federal Reserve gives it value of $5. Thus, this is an example of fiat money because the government has decreed that it's worth $5 worth of goods and services. One of the oldest economics laws is Gresham's law, which says there are two types of money in circulation. The type of money which has real value will be hoarded or kept out of circulation, and the type of money which has no value will be used in the economy. The typical phrasing of Gresham's law is bad money drives out good money from circulation. As we learned earlier, money is a tool used to make economic transactions easier to occur. There are 4 specific ways money helps us with economic transactions. First, money acts as a medium exchange by limiting the double coincidence of wants problem. 2, money helps us measure the value of goods and services. Goods and services that have a higher price are more valuable than things that have a lower price. Thus, the more money one receives in wages, the more valuable the employee is to that company. 3, money is used to measure value that has been stored for future use. And finally, money is used to measure payments to a creditor in the future. In the United States, there are two ways to measure money. First is M1 and the second is M2. The definition of M1 is the sum of currency, coins in circulation, demand deposit or checking accounts, traveler's checks, and other checkable deposits like draft accounts. M1 is the most important measure of money for an economist because it is the most liquid form of money. The definition of M2 is M1 plus savings account plus small time deposits plus retailer money market accounts. M2 is less liquid in M1 because of the inclusion of savings accounts and small time deposits. Savings accounts typically are not redeemable on demand. That is to say, the bank or the savings institution can deny you access to your savings account for a fixed period of time. This is usually spelled out in the agreement that you sign when you start up a new savings account. Time deposits are similar because a time deposit is a contract between the saver and the bank, and the bank has required that the saver keep the money in the bank for a certain amount of time. So for example, a time deposit might be 6 months, a year, 18 months, or 3 years. Once again, the time frame is not what's important. What is important is that there's a contract between the saver and the bank which limits the ability of the saver to access the funds. Some other payment interests that you might need to be familiar with are checks, which are basically orders to a bank to give an individual money. Money orders, which are orders to non-financial companies to give an individual money. ATM debit cards are essentially electronic orders to transfer money from one bank account to another. Electronic transfers are orders to transfer money from one bank account to another bank account. And finally, credit cards are really loans to an individual.